In the autumn of 2008, a man named Gerald, a retired schoolteacher in Ohio, did everything right. That is the part that makes the story worth telling. He had read about inflation. He had watched the dollar weaken through the early 2000s. He had listened to the arguments, followed the logic, and in 2007, he moved a meaningful portion of his retirement savings into gold. Not a gamble. A considered decision, grounded in a century of evidence that said gold holds its value when paper systems come under pressure. When Lehman Brothers filed for bankruptcy on September 15, 2008, Gerald expected his gold to do what gold was supposed to do. It fell, not slightly. Gold dropped roughly 30% from its March 2008 peak by the time October arrived. While the financial system was visibly fracturing, banks failing, credit markets seizing, the Dow losing a third of its value in weeks, the one asset Gerald had chosen specifically because it was supposed to survive exactly this kind of event was moving in the wrong direction. He was not wrong about gold. He was wrong about timing. And the gap between those two things, between being right about an asset and being right about when it does what you expect, is the gap that has swallowed more careful, well-researched financial decisions than almost any other mistake in the historical record. This is not a story about gold failing. It is a story about what actually happens in the first phase of a crisis versus the second phase versus the third, and why those phases almost never behave the way the people inside them expect. To understand what happened in 2008, you have to understand what a liquidity crisis actually is at the level of the individual investor, not the system. When credit markets freeze and margin calls cascade, fund managers and institutional investors do not sell what has fallen the most. They sell what they can. Gold, in September and October of 2008, was one of the few things still liquid enough to sell. It had not collapsed yet. It had value, and that value made it the most useful thing to offload when everything else had stopped trading cleanly. So gold fell not because it had failed as a store of value. It fell because it was working too well as a store of value. It was the asset people trusted enough to sell. That distinction matters enormously, because the same pattern, the asset that falls first, precisely because it is trusted, has appeared in almost every major liquidity crisis in the modern record. And almost nobody recognizes it in the moment, because it looks exactly like failure. By November 2008, gold had bottomed. By February 2009, it had recovered its pre-crisis level. By September 2011, it had more than doubled from where Gerald had watched it fall in the autumn of 2008. His retirement savings, if he had held, were substantially larger in real terms than they had been before the crisis. But the question is not whether he held. The question is what the fall looked like from the inside, in real time, with no knowledge of what came next. And the honest answer is, it looked like being wrong. That is the first layer of this. The surface problem is that gold did not immediately rise in a crisis. The deeper problem is that most people, including many who hold gold specifically for crisis protection, have no mental model for what the first phase of a crisis actually looks like, and so they make decisions based on a story about phase 2 while they are still living through phase 1. Now go back further, because 2008 was not the first time this happened. In 1931, as the Great Depression was deepening and bank failures were accelerating across the United States and Europe, gold-backed assets were supposed to be the safe harbor. The gold standard was still formally in place in most of the major economies. Gold was not just a store of value, it was the foundation of the monetary system itself. And yet, in the acute phase of the crisis, between 1929 and 1933, something uncomfortable happened. The people who held gold-linked asset savings accounts in gold standard banks, bonds denominated in currencies backed by gold, discovered that the link between the paper promise and the metal underneath it was not as direct as they had assumed. Banks failed. Deposits were frozen. The gold was there, somewhere. in vaults and reserves. But the mechanism for translating that gold into purchasing power for an ordinary depositor had broken. A farmer in Iowa in 1932 did not care that his bank held gold reserves. His account was locked. His crops needed to be sold. His mortgage payment was due. The gold in the vault was doing nothing for him. What mattered in that moment was not what the asset was. It was what the asset could do, right now, in this specific week, given the specific mechanisms that were still functioning. The people who came through the Depression's acute phase with their financial position intact were not, in most cases, the people who had the most gold exposure through institutional channels. They were the people who had gold directly coins, sometimes small bars, or who had converted a portion of their savings into things that could be exchanged locally without requiring a bank to honor a promise. The gold standard did not protect depositors. Direct gold ownership, in physical form, did something different. The difference was not the metal. It was the layer of institutional dependency sitting between the person and the metal. This is the second layer. And it changes the meaning of what happened in 2008. Gerald's gold fell in 2008 not just because of liquidity dynamics. It fell, in part, because he held it through financial instruments, ETFs, mining stocks, paper proxies that were subject to the same institutional pressures as everything else. The gold underneath those instruments was fine. The instruments themselves were caught in the same machinery that was grinding everything down. Which raises the question that the Depression already answered, quietly, 80 years earlier. What is the difference between owning gold and owning a claim on gold? And which one are you actually holding when the system comes under pressure? Drop a year in the comments, the year you think was the single most dangerous moment to be holding paper proxies for real assets. I read every response. If this is the kind of history you want more of, the kind that traces patterns across crises and helps you see the present more clearly, subscribing keeps it coming. There is more of this. Now, here is where the script has to make an uncomfortable turn. Because there is a case in the historical record that appears, at first glance, to break everything that has been said so far. A case where holding physical gold, not paper proxies, not institutional instruments, but actual gold coins in actual hands, produced a catastrophic outcome. And if that case is real, then the entire frame built so far needs to be reconstructed. The case is the United States, 1933. On April 5th, 1933, Franklin Roosevelt signed Executive Order 6102, requiring American citizens to surrender their gold coins, gold bullion, and gold certificates to the Federal Reserve. The official price was set at $20.67 per troy ounce. Compliance was not optional. Non-compliance carried penalties of up to $10,000 or 10 years in prison, or both. Within months, the government revalued gold to $35 per ounce. The people who had surrendered their gold received $20.67. The government, now holding the gold, received $35 of purchasing power per ounce. The gap between those two numbers, roughly 40%, was the transfer. Legal, official, and irreversible. This is the major structural reversal. Because if a government can simply require you to surrender the physical asset at a government-set price, then physical ownership does not solve the problem that was identified in the Depression case. It just moves the risk from institutional failure to institutional confiscation. Different mechanism, same outcome. You thought you owned something. It turned out you owned it conditionally. And yet, the story does not end there. Because not everyone surrendered. Estimates vary, historians still debate the scale, but a meaningful portion of privately held gold in the United States was never surrendered in 1933. Some was held in safe deposit boxes that were never reported. Some was held in forms that fell outside the order's specific definitions. Some was held by people who calculated, correctly, that enforcement was logistically impossible at the individual level for small holdings. And some was held outside the country entirely in Swiss accounts, in Canadian holdings, in forms the order could not reach. The people who held gold outside the reach of the order and held it through the subsequent decades, through the Bretton Woods period, through the closing of the gold window in 1971, through the eventual re-legalization of private gold ownership in the United States. In 1974, those people saw gold move from $35 an ounce in 1933 to $180 an ounce in 1974. In real purchasing power terms, accounting for the inflation of those 4 decades, that is a meaningful preservation of value across a period that included a world war, 2 recessions, and one of the most significant monetary system changes in modern history. They rebuilt. Not quickly, not without cost, but the purchasing power that survived the crisis, in the hands of people who held the right form of the asset in the right place, compounded quietly across 40 years into something real. This is the 3rd layer, and it changes the question entirely. The question is no longer, does gold work in a crisis? The question is, which crisis? Which phase of that crisis? Which form of gold? Held through which institutional layer? In which jurisdiction? For how long? Because the historical record is not uniform. Some crises lasted days, some lasted decades. Some froze assets temporarily and resolved cleanly. Some transferred wealth permanently and irreversibly. The 2008 crisis was acute, terrifying in the moment, and largely resolved for gold holders who did not sell within 18 months. The 1,933 confiscation was permanent for the people who complied and multi-generational in its consequences for the people who found ways not to. Not all crises are equal. Not all gold exposure is equal. And the difference between those 2 facts is where most of the real financial history actually lives. Now move to a case that sits between those 2 extremes. Because the 2008 and 1,933 examples represent the poles, the liquidity crisis, where gold fell and recovered, and the confiscation where gold was taken at a discount. But there is a 3rd type of crisis that is in some ways the most instructive because it is the most common and the least dramatic. The slow erosion crisis, where nothing appears to break and everything gradually does. Germany in the early 1920s is the obvious hyperinflation example, and it is worth visiting not for the wheelbarrow photographs, but for what the gold holders actually experienced, week by week, as the mark collapsed. A German family that held physical gold coins in 1921 did not feel wealthy in the conventional sense. Gold was not officially priced in marks at a rate that made sense. The official economy was denominated in marks. Wages were in marks. Rents were in marks. Government obligations were in marks. Gold sat outside that system, awkward and illiquid in the daily economy, but quietly preserving something that marks were not preserving: a stable unit of exchange with the outside world. By 1923, when the mark had effectively ceased to function as a store of value, the families that held gold could exchange it carefully, quietly, through informal networks for goods, for property, for claims on productive assets that were now priced in collapsing marks. A small gold coin that had seemed modest in 1921 could purchase, by 1923, assets that had been worth far more in mark terms just 2 years earlier. The purchasing power of gold had not increased in any absolute sense. The purchasing power of everything around it had collapsed. The gap between those 2 things was the transfer. A man named Heinrich, a small merchant in Munich, by most accounts typical of the middle-class savers of that era, had converted a portion of his savings into gold sovereigns before the war. Not a large sum. Enough to matter. By 1923, those sovereigns purchased a building that had been owned by a family who had kept their savings in mark-denominated bank accounts. The building produced rental income. The rental income, eventually, produced stability. The family that sold the building lost not because they were careless or uninformed. They lost because the form of their savings required an institution, a bank, a currency to honor a promise, and the institution stopped honoring it. Heinrich's gold required no institution. That was the difference. But here is what the German case adds, that the 2008 and 1,933 cases do not. The gold holders in Weimar Germany who came through best were not the ones who held the most gold in isolation. They were the ones who held gold alongside other things that functioned when the monetary system did not: productive land, tools, skills, social networks, the ability to produce something that other people needed regardless of what the currency was doing. Gold was the bridge. It preserved purchasing power across the gap between the old system and whatever came next. But the people who held only gold and nothing else, no productive capacity, no relational capital, no practical skills, found that the bridge led somewhere they could not build from. The asset preserved value. The life had to be rebuilt from something more than preserved value. That is the fourth layer. And it is the one that most financial history narratives miss entirely, because it is not really a financial observation. It is an observation about what wealth actually is when the system that defines it stops functioning. Which brings the story back to Gerald. In Ohio. In the autumn of 2008, Gerald held. He did not sell when gold fell in October. He did not panic when the instruments moved against him in the acute phase. He had read enough to know that the first phase of a crisis is not the last phase. He watched gold recover through 2009, rise through 2010, and reach levels in 2011 that made his original position look, in hindsight, like a well-timed decision. But Gerald also told anyone who asked that the fall in October 2008 was the hardest financial experience of his life. Not because of the money, because of the uncertainty, because he had done the research, made the considered decision, held the right asset for the right reasons, and watched it fall anyway, with no way of knowing, in real time, whether it was falling because the thesis was wrong or because the thesis was right. But the timing was phase one. The historical record, across 2008, across 1,933, across Weimar Germany, across every liquidity crisis and confiscation and slow erosion in the modern financial record, keeps returning to the same distinction. Not which asset, when in the crisis, which phase, which form, through which institutional layer, for how long, with what else alongside it. Gold did not fail Gerald in 2008. The first phase of a liquidity crisis did what the first phase of a liquidity crisis always does. It sold the liquid, the trusted, and the real before it sold the illiquid, the speculative, and the nominal. Gerald's gold was caught in that mechanism. The mechanism resolved. The gold recovered. The thesis was right. The timeline was longer than one season. The question the historical record keeps raising is not whether gold works. It is whether the person holding it understands what phase they are in, what form they are holding, and how long they are prepared to wait for phase two to arrive. If something in this shifted how you think about the assets you hold even slightly, leave it in the comments. One sentence is enough. Tell me which case landed hardest. Of the assets you currently hold, the savings accounts, the ETFs, the funds, the instruments of various kinds, how many of them require an institution to honor a promise before they have value? How many of them would continue to function if that institution paused, restricted, repriced, or reorganized itself overnight? And of the ones that would survive that reorganization, how many are you holding in a form that would actually be accessible in the first phase of the crisis, before the second phase arrives to vindicate the thesis?